Moving Iron Podcast is proud to be part of the Global Ag Network. The network is going live soon, so check out globalagnetwork.com for more details and updates. Now on to the show.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello, welcome to Moving Iron Podcast Tax News with Glen Birnbaum.
Yeah, these MFP payments, these trade aid payments, was at a Deep End Ag Summit conference a few weeks ago. I was talking to, a number of farmers in the break. And, the common question is, well, can I elect to take my money in 2018 here, but somehow for tax purposes, they don't defer that income until 2019? And that question comes up. It's a good question because in certain cases, you can do that with crop insurance payments. And so we thought we'd maybe talk a little bit about that today. But the quick answer on the trade aid and the MFP payment is if you receive the check in 2018, it's taxable income in 2018. You cannot defer this payment until 2019. So that's the quick answer. But for crop insurance, generally speaking, if it's weather related, a drought or something, and your bushels are harmed, right? So you're receiving insurance because you have less bushels. That is eligible to be deferred, because basically all you have to do is kind of prove that, hey, normally I would not have, sold my grain and taken the check until next year under my normal kind of business practice, right? And so just because the insurance company, cuts me a check in December of 18, doesn't mean I have to record it as income. You can make a special election and defer it until 2019. So that's for yield, for lost bushels. But if it's, more of a insurance payment that's for the price, right? You've got some sort of guaranteed price kind of thing, you're protecting your revenue overall, then those type of payments, insurance payments, cannot be deferred. So for weather, for bushels, you can defer a crop insurance payment. If it's the price, you cannot defer a crop insurance payment.
Right.
So, for example, I know there was some lost bushels, maybe in Missouri or with drought, things of that nature. Potentially some producer, there could do this, but as a general rule of thumb, probably for this year, probably can't defer too much of the crop insurance payment. But, check with your insurance person, understand how much is for yield, how much is for price.
Right. So do you have to, when you're doing your taxes, do you have to declare that payment as like this much was for yield, this much was for price?
Yeah, if you can break that out, you could, you'd have to document it. You wouldn't actually, necessarily attach that to the return, but you would have to have, work papers that would support it. And it's, and obviously if you defer it, then you got to make sure you remember to, recognize it next year, right? Don't accidentally forget about it. It's a special line on the Schedule F where you're telling the IRS, hey, I received this money, but I'm electing to defer it. So, so that's crop insurance.
Okay. Now, earlier in the week you had, or maybe it been last week even, you had a tweet that you put out there about on farm equipment, new equipment. It's kind of funky. New equipment, 7-year depreciation, and used as 5. So even the IRS was a little confused on their own.
This was. Let me see if I got this right. We had an in-house training session a few weeks ago, and we told our people, hey, watch this, make sure. But then the IRS finalizes their publication 225, which publication 225 is what's called the farmer's tax credit. So that comes out on Friday, December 8th, I believe. Yes, Friday, December 8th. And on Saturday morning, I look at it, and would you believe the IRS is confused themselves? Because they do not even mention, on the very first page, it says what's new, which is, kind of a key part. And you read that section, and they say what's new in 2018 is all farm equipment is now 5-year life, which is wrong, because it's only new farm equipment that's 5-year life, and used farm equipment is 7-year life. So on the very first page, it's wrong. About 20 pages back, it's wrong. And then there's a table that if you were really, really sharp, you might be able to interpret that maybe it's lightly referring to the fact that there's a difference, but they're just flat out wrong. So I think you could change the publication. But, it's because everything's so confusing, right? I mean, if the IRS is confused, what are taxpayers supposed to do?
Right.
But you just have to realize that, used farm equipment is still the old rules, and new farm equipment is a lower life. It's 5 years now. So be careful. But if you're electing to write off all the purchase price in the first year, right, either through Section 179 or now 100% bonus depreciation, this really does not matter.
Right.
Right. If I write it all off, but if I don't want to take all that depreciation and I like to depreciate it normally, there are going to be people, doing it incorrectly. So I don't know. I would hope the IRS can actually change this publication, because it's not a draft publication. It was a final publication they posted out there Friday, December 8th.
Yeah. Well, good thing all this fits on the back of a postcard. That's
right.
I'm excited about.
Back of a postcard.
Yeah. That's a long ways from that, right?
Other things that have happened here since we last talked, it's been a little while, that we've talked a lot about the 199A rules, this new 20% deduction. The proposed regulations came out in August. There was a hearing in October. Now the final 199A regulations, we haven't been able to see them yet, but we know they're at the Office of Management and Budget for like a kind of a review before they're released, and they were out there. Let's see, December 14th is when they were posted out there. So again, we can't read them, but people are saying, hey, this probably means, and I think we would hope that this means that they will be released by December 31st, just so we know what the rules are. Maybe we have a couple days to do something, but just so we know what the rules are. Because if they're not released till January of 19, then it's kind of confusing. Do you have to follow these rules or not? They don't really take effect until 19. So we've heard that they want to definitely by the end of the year, and they are at this last stage of review by the Office of Management and Budget. So likely these regulations will get finalized, hopefully. At least that's what I'm hoping for, just so we know what the rules are.
Right.
Interesting, though, the 198 proposed regulations for the grain village FedEx, which we've obviously talked about this over the past few months, several months, back into March, those have never actually been released yet. So we're not sure what's going on. They said, hey, we're not releasing these yet, but it's been, again, since August, since the other rules were out, they have not issued any proposed regulations on this grain village FedEx. That's the deal with the co-ops and things. So we're not sure why they wouldn't at least issue proposed regulations unless they're confused or there's some technicality they're still wrestling with. So that's a big surprise to me that we don't have at least proposed regulations on the grain village. So
yeah. It's pretty bad when when the entity that is creating the tax laws is confused by their own laws. And it's how,
And then the other thing I just saw today, somebody else pointed out that and this is a key thing we're really working with clients on is, if you now trade off a piece of equipment, we've talked about this, if you trade off a piece of equipment, it's as if you sold it. And it's not a terrible problem because, you can now depreciate the full amount back, right? You can, so in theory, you could be back to even on this. But one of the challenges is you could have a lot of income on what's called a 4797, and then you're going to have to show a loss on your Schedule F to offset that. Right, so you're back to zero, but then you won't be able to make like a retirement plan contribution for yourself because you don't have any earned income. Because your earned income, the retirement plan contribution is based on your Schedule F income, not your overall income. So we've talked about this, but this person pointed out that the IRS is wrong because it basically says you can't Section 179 trade anymore. These last year's rule, you can't Section 179 old basis in the trade. If you had leftover basis, but that rule just got blown up. So you can 179 something you traded off because there is no trade. So it's not quite as bad of an error, but again, it's just showing that the IRS isn't, they've got a lot of work to do. I'm not saying, I guess you got to look, use it on the other foot, but you can't just last year's rules, right? You've got to look at every paragraph and make sure it's correct. And there's a few cases where they haven't updated the paragraph, but I just think it's it's particularly unfortunate that there's a section called "What's New." And they wrote this section, right? It's not just changing the section in the back; it's "What's New." It's a paragraph, and it's wrong. It says, all basically farm equipment is now 5-year life. If it's placed since 2018, and that's just flat out wrong. So it's a high challenge, but boy, you'd like to think that this would get reviewed so that they don't confuse everybody. So
yeah. Have you read anything about the machinery depreciation schedules being aligned with each other where new and used become the same, or is that like an unforeseen glitch on their end?
Good question. Yeah. I looked back at some articles, that were written, in January, and I didn't really see too many people point this out, that there was a difference between new and used. But if you go back to the code section, there's an actual code section, which is what Congress, officially passed. It does refer to, it says it's 5-year life, but it says the original use of the equipment must reside with the taxpayer, or something like that. So if you kind of stop reading, you might not catch that, but it's got to be the use has to start with the farmer, which means it's new. So it's very clear in the code that was the case. I'm not really sure why that was. It leaves it's the same life for everything, whether it's new or used. I'm trying to think. Good question. If there's any other type of equipment that has a different life if it's new or used, I can't think of anything, or a building or anything in my close to 20-year history is generally the same life, whether it's new or used. So Congress, in their wisdom, now has this tweak that says, "Hey, we'll make it 5-year new," which I assume would obviously incentivize people to buy new. But I think it's just not a typical thing that we have to deal with. So we get confused, even the IRS gets confused. But it is clear in the code that that's the rule. It's just I don't think many people read it that way initially.
Yeah. You'd think just because of depreciation with the 179 stuff that they'd want to make both of those equal. You know what I mean? Because there's really no benefit one way or the other. When you.
I really think they were thinking through it, because if it's new, most people are going to rent it 100% off anyway. Or right. It's kind of a moot point. But with the way things work, right? If eventually bonus depreciation goes away, Section 179 goes back to more normal levels. But this 5-year versus 7-year rule is still right if you don't change that part of the code. So maybe they were thinking down the road 10 years or something. We still want to give a preference to new, but boy, that's really playing the long game. So
yeah,
it's going to confuse a lot of people in near term. So.
And the government does that so well.
Yes, it is. But I could not believe that publication was that. I mean, there's a lot of, I just couldn't believe it was just blatantly wrong. I mean, it's really kind of sad.
Yep. Well, it is.
They're going to fix it.
Well, it is. I mean, there's gonna be an accountant someplace that's quote unquote following the letter of the law, and they're gonna end up costing the client a bunch of money because they did what the IRS said they were gonna do. To do.
That's just thinking the public. It's a publication by the IRS, so it's not it's not the code, it's not regulations. There have been cases over the years where if somebody relied on a publication, and there's been cases where the publication is wrong. And then the taxpayers get, hit with penalties or something like that. The IRS says, hey, the publication is not authoritative. So basically, we don't have any responsibility that our publication, that's happened a few times with some court cases over the years. So it's kind of sad when the IRS own publication, they don't stand behind it.
Yeah. We're not responsible for what we publish.
Yeah. So,
it's crazy.
Anyway, so just be aware, make sure you talk to your tax person, your CPA. We're very busy right now working with various clients with tax planning, and but if you hear something, if you read something, don't be afraid to mention it to your CPA, because it really does take a team this time of year to make sure we're thinking of all the possibilities, because there's just a lot of new changes out there. So just really encourage communicating with your tax professional.
Right on. All right, Glenn. So, like you said, plenty of stuff going on, and obviously lots of things to pay attention to. Watch the watcher type deal. So, if folks have a tax question or if they have an issue they would like to bounce off of you, how would they do that?
Yeah, it's best to call our office here at Heinold Banwards. My phone number 309-694-4251. Also, follow me on Twitter at handle. Keep things fairly current there with the latest in what we're seeing with our clients. So those are two of the best ways to reach out to me. And be happy to talk to anyone as we close in on a year end.
Right. And if you're not following Glenn on Twitter, make sure you do that. Like you said, there's tons of stuff he puts out there, and then the replies and stuff he gets back from other CPAs, and they start talking tax stuff back and forth there on Twitter. You get some good stuff out of that. So make sure you follow Glenn.
It's fun stuff, man. What else would you want to do than follow people talking about tax on Twitter?
I mean, I'm super jacked when I see it. Come on, Glenn. I can't retain myself. But yeah, it's good stuff. Good stuff. All right. Well, I'm Casey Seymour with Moving Iron Podcast, now part of the Global Ag Network. So, Glenn, till next week. Well, I guess later this week we're gonna touch base again. Touch base again later this week. And till then, have a good rest of your week, and we'll talk to you then.
Okay. Thanks, Casey.
All right. Take care, bud.
Moving iron in the 21st century. Hardworking people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving